Now's Ayesha Faridi caught up with the MD and CEO of BSE, Sundararaman Ramamurthy, in an exclusive chat on a whole host of market chat points. Let's listen into an excerpt of that conversation.
Well, I'm here at the country's oldest stock exchange, the Bombay Stock Exchange, with the turnaround man himself, the MD and CEO, Mr. Sundararaman Ramamurthy, right here with me at the Bombay Stock Exchange. How does the turnaround feel now? I can see a lot of newness in the building already as soon as you step into the premises.
We are doing our efforts to make it look good and long way to go.
Long way to go. The country as well, at least the growth numbers, they are also looking good, almost touching 8%. The question is whether it's going to stay this way or not. From your hat, and you're obviously an economy watcher, with all that we've seen the government do in terms of the move by the RBI, you know, everything from the tax cuts now trickling into the system, and of course the big one, the GST bonanza, but at the same time that seesaw, which is still question mark on tariffs. What is your view of the economy?
If you're referring to the last quarter growth where we recorded a 7.8%,
yes.
If you look at it consistently, if you take the average for the past few years, we have been doing well, hovering around 7% growth. The policy changes and the direction which is being taken by the Honorable Prime Minister is making that possible to happen. The last quarter, 7.8%, is a result of increasing demand and the policy initiatives. Basically, these are the two important drivers. In some of the sectors like services, manufacturing and construction have done indeed very well. The current profile of the population makes it easier and possible for steering this growth. And India at this point of time is in a very important position. The tenacity with which today India has pursued its energy independence and security and safety and growth of its countrymen and ushered in nicely a paradigm change makes me feel we are in a great place to go. I think this economic outlook, what we are talking about, looks very positive to me because of all the things that we are seeing. The location where you are strategically placed in Indian Ocean, through which so much of trade happens. The diversification that has happened in terms of relationship, which once again underlines concentration risk, whichever way it is and wherever it is, should be immediately taken away. And the consumption growth story of India, the rising middle class, the realignment in global policies, and the reforms in the form of GST and whatnot, clearly makes that 7.8 is here to continue and more to be seen.
Okay. But tell me, I don't know if it's fair to ask you, you think this optimism is built into the stock markets right now? Because the FPIs and the FIIs has been consistent sellers throughout the year pretty much, and some months in very large quantums. Why is that so?
I look at it slightly differently. See, if you find a glass with half-filled water, you know how to look at it. Two ways, right? Half-filled or half-empty. I look at it as half-filled. How do I say that and why do I say that? FPIs have always been coming in and going out at opportune moments for them to make money. Earlier on, when I was a younger man, if somebody sneezes somewhere across the globe, Indian markets used to have fever.
Yes.
That's not the case anymore. You talked about FPI selling. You talked about trade tariffs and changes. Indian markets are withholding. How? The support that you are getting from the domestic institutional investors. Today, if somebody sells 7,000 crores, DIIs are ready to buy 10,000 crores. Where this financial muscle is coming from? It is from the retail public reposing confidence into the Indian economy and through mutual funds contributing significantly their domestic savings into the financial sector. So I feel it is a very optimistic moment where my countrymen are able to showcase their strength to not only offset what is being taken away by somebody, but also to make it strong and stay put. That's how I look at it.
So good times ahead for equity markets.
Absolutely. I'm born positive.
I can tell.
We had single contract of weekly expiry per exchange with the option to choose the expiry day. Since Thursday was chosen by the other exchange, I chose Tuesday. I was very clear at the time. No longer my product will be expiry day product. It will become an active product on all days. And it became. And when it becomes active across all days, this is the time to push the envelope to the other days of the week, other expiry days, next week, next to next week, and to the next month. We started doing it. From nothing there, we reached around 3 to 5% of volumes coming from non-expiry week volumes. Not this week, next week, next to next week, month. Now the third thing happened. Since the other exchange wanted Tuesday, I think for once I wanted it to settle down. So we gave Tuesday and took Thursday based on the voice of customers. My market participants felt Thursday is a better day because Thursday has been the expiry day for a very long time in Indian derivatives market. Mentally, they are tuned to Thursday. And as against the talk of 2 days, 3 days versus Tuesdays and Thursday, the market participants told me, if it is Thursday, actually it is 4 days you get, so you should take Thursdays. It's early days, just one expiry has gone. We are waiting and watching. But what we are clearly seeing is the market behavior taking next week, next to next week, and monthly options. This is what I call as deepening of market. I need to deepen to get more depth into whatever product we have. In all these parameters, we are doing well. Of course, it's human tendency. Dil mange more. Whatever you do, you want to do even better and even more. So we will work hard towards it.
So more volume buoyancy.
More towards non-expiry week, so that it is deepened and broadened. The product has to be very strong.
Any new launches expected going forward? IPOs, mutual funds? What's going to be the focus?
See, the IPO market has been doing extremely well in India. In the last 8 months, around $10 billion worth IPOs have been raised. If you look at the approvals that have been received from SEBI, around $15 billion worth approvals are already in place. I'm told another 20 billion is in the pipeline. It's a big number. The IPO market is very healthy. The temporary imbalance because of all the tariff talks that have been happening might have made some of the people who have got approval to slightly wait and watch. But some of the IPOs which came have seen a lot of oversubscriptions and good listing prices and continuing to remain strong.
And quality IPOs also.
Absolutely. That's very, very heartening, as you rightly mentioned, quality IPOs. So the IPO market is very good and we have geared up for doing a lot of good things there. When you talk of IPOs, you cannot leave SMEs.
Of course.
SMEs are very important. And I've always been telling this, out of 6 crore SMEs, don't we even have 6,000 SMEs to get listed? Recently, we touched the milestone of 600 SMEs getting listed. In that, the last 100 alone has contributed for 4,000 crores of capital raising. Unlike many of the bigger IPOs which we have seen, these are not OFS. They are fresh capital raising, contributing to the economic growth. Mutual funds, we are doing extremely well. When I joined 30 months plus before, the number of orders we were handling per month was around 2 crores. Today it is more than tripled. We are handling more than 6.5 crore orders per month. The length and breadth of the penetration of mutual funds is very good. And I feel this is another area where there is huge potential. the demographic profile, beyond 30 cities, the expansion of financialization of householding saving schemes, and compared by any global standards, the number of AMCs and schemes and distributors we have is still a scratch on the surface, lot to do. And 65% of the population going to be in income earning group. We are targeting a very huge population whom we want to come through the mutual fund route. It is obvious. You talked about a question about FPIs taking money away and how strong the market is. Domestic institutional investors, we want mutual funds to be strong. Apart from this, we have some product ideas which we can bring in. But initially, we want to stabilize all this. Once things become stable and we have come to a situation where we are more matured, more products will also get added.
Given that the market regulator, that SEBI, is also looking at optimizing and increasing cash volumes in the markets, also long-term derivative contracts as well, geared up for all of it?
In terms of system capability, we are geared up for all of them. We also have a couple of thought processes in this. And the regulatory system has been very conducive. It's a co-created process, which I always say. If you recall, very recently, the regulators permitted the common contract note in the cash equities, which has been a big hurdle for BSE in ensuring level playing field and getting institutional volumes. With the common contract note being in place, we are working very hard on getting SOR activated and best price execution to come into the institutional arena, which is absent till now. Once that happens, the concentration risk that you have today in cash equities should ease out, and that should make good progress for BSE. And also for all the newcomers who are going to come into the market, for them as well, there should be enough room for growth, which I think this effort that we are putting in is just not for BSE, it is for the market and all the new players as well. In terms of derivative, in terms of cash market, there are certain reforms also we think we should think about. One is today there is no leverage in the cash market, and because of that, no people who feel that there is more leverage in the equity derivatives immediately switch on to equity derivatives. People who continue with cash equities, they find taking delivery very costly because the STT is the highest. If you recall, when STT was brought in, it was brought in lieu of capital gains. Today we have both, and the STT is very high, in fact the highest for cash delivery volumes.
Do you think taxation needs to be brought down?
It has to be rationalized, and maybe to encourage probably the SEBI turnover fee or the SGT in terms of cash equity delivery volumes, they could be rethought about and they should be rationalized so that it's made attractive. Some leverage and some leveraged products and affordability increased and an attraction being given. I think cash equity volumes will grow up for retail people. And some of them who are today participating in equity derivatives, they move away from equity derivatives and come into this. And also to build a healthy market for long-term options and long-term derivatives, quite a few things we need to do. There is no institutional presence in a big way at all in the long-term options market. Today you go to a common man and you talk to him about delta, gamma, vega, rho and theta. He talks with great ease. I don't know how much it makes sense for a mutual fund manager to talk about any of this other than alpha and beta. The reason is they are not trading in any of these products. If you were to make a mutual fund scheme for retailers which uses derivative strategy so that the loss and profit numbers could be fixed a priori because the strategies mend itself that could be a better way of channelizing the retail volumes into the mutual fund to participate in derivatives. The advantage is mutual funds will be trading in longer term options and longer term futures, unlike a retailer who may get into a shorter term futures and shorter term options. There are no structured products, access products, no leveraged ETFs, no inverse ETF in this market.
So starting soon?
If they all happen, then what happens is the longer term tenor of the options market become attractive for these players, and that brings in a balance into the market. So these are some of our thought processes. Systemically, we are extremely geared up because of all the innovations that we talked about and all the infrastructure building that we are doing about.
If you like this video, then like, share and subscribe to ET Now.